Hey guys, Dr. Stitzel here. In this video, we're going to go over the Federal Reserve, as I've called it throughout the semester, the Fed. Fed is what economists refer to the Federal Reserve, so sometimes that's a little different than what you might see in other places where the Fed might refer to federal government or something. The Federal Reserve is the central bank of the United States. There's lots of examples of central banks elsewhere around the world. They are often called the central bank of insert country here, but we call ours the Federal Reserve. The Federal Reserve has four parts: the Board of Governors, the Federal Open Markets Committee, the regional Fed banks. There are 12 regions. We'll cover those in a bit. And then member banks, so individual private banks that then belong to the Federal Reserve System. Those regional Fed banks represent the different regional districts. Here in Canyon, we are in the 11th district, where the seat of that regional Fed is the Dallas Federal Reserve. So the Fed has four main goals. The first is conducting monetary policy. This is probably the one that you would have heard of or you would have guessed if you knew nothing about what the Fed does. Okay, so it monitors money and credit conditions, and then it uses a variety of different policies, which we're going to discuss throughout this lecture, in pursuit of full employment and stable prices. There's a lot of debate amongst economists in particular if the stable prices should be more the focus necessarily than the full employment. This is what's called the Fed's dual mandate. The Fed does some other things, though. One is supervising and regulating bank and other financial institutions. Okay, so they actually watch over banks, and they audit and supervise and regulate banks. I remember I was teaching my graduate class in advanced macroeconomics, and there was a paper that was covering some of the regulation that they installed called the Dodd-Frank Act after the 2008 financial crisis as a response to that crisis. But I was reading a Brookings Institution article on it, and it said, there's a big failure among bank regulations by the SEC. So I couldn't use that article then because the SEC doesn't regulate banks. The Fed does. So this was a big red flag that whoever's writing this didn't know much about the situation. So there's some good things to learn out of that kind of knowing those kind of things. One of the things that they do as a part of this regulation and supervision is to protect consumer credit rights. So they try to protect people that are using banks, or at least nominally, this is what they do with regulation. We've discussed public choice elsewhere in the class, so there's some problems with that. But at least nominally, right, at least in name, that is what they try to do. The next thing they do is try to maintain the stability of the financial system. This is especially important in 2008 forward, right? So in this class, or in any macro or money, credit, and banking class that you're going to take, you're going to hear a lot about the 2008 crisis. Okay, that seems like it's far away. That's 14 years ago. But this was a watershed moment in American monetary history, right? We've had other types of systemic crisis elsewhere in the world, but nothing to this scale and nothing in the United States to that level. But one of the things that the Fed is trying to do in terms of maintaining the stability of the financial system is to limit what we call systemic risk. So banks are unusual, right? If we think of a different type of industry, different types of businesses, if one goes under, not only does it not weaken its competitors, it strengthens them, right? We have GM and Ford and Toyota, and they're all competing. If GM goes out of business, does Ford get weaker? But clearly not, right? They actually get stronger. They'll have more market share. They'll be able to produce more. Banks are not like this, okay? Banks are linked in ways that firms in other industries are not. This has to do with overnight lending for the most part, but different ways the banks are leveraged, and banks particularly hold a different asset profile than other types of businesses, right? So other types of businesses want to hold long-term liabilities and short-term assets, and therefore banks have to hold the opposite, which makes them very naturally, by the way that they are designed, makes them prone to certain kinds of risk. One of those is systemic risk. So systemic risk is simply the idea that if firms begin to fail, it will cause other firms to fail, right? So if you look back at the conversation around 2008, systemic risk was a big issue there. So the Fed tries to fight off systemic risk. Of course, I would argue, and other critics of the Fed would argue, that a lot of the things the Fed does actually increases systemic risk when they're not fighting failures or recessions. And by failures, I mean like banking failures, right? Banks going out of business. And so they sort of make their problem worse. So there's a new book that's making a lot of waves in macroeconomics called Money and the Rule of Law, Generality and Predictability in Monetary Institutions by Peter Boettke, Alexander Salter, and Daniel Smith. In this, they have a chapter in there called When the Firefighters Are Arsonists, right? And they cover the history of how the Fed makes systemic risk more of an issue with the way that they treat banking failures, so that they make future problems substantially worse. And there are lots of important economists like Arnold Kling that make this kind of case as well. So this is a big part of what monetary economists are talking about right now. Now, the fourth goal is then providing financial services to the U.S. government. So other banks, foreign banks oversee payment systems, serve as a bank to U.S. Congress, etc. So the Fed is a large bank. You will not go wrong in thinking about the Fed as a bank. Okay, so one of the things then that is really important because of this fourth goal is what's called Fed independence. And this independence stems from one very important thing, which is that the Fed's actions are not subject to executive branch control. So they cannot be told what to do by the president or anybody in the executive branch. There was a pretty notable case where President Trump, during his term, was tweeting at the Fed trying to tell it what to do with interest rates. Of course, the Fed is not interested in what Trump or any president has to say. Now, that being said, the sort of public channels like that are not very effective. It's not obvious, though, that there aren't backdoor channels. And so, again, referencing this book that's so important in macroeconomics, Money and the Rule of Law, you actually see good evidence of sort of backdoor channels where Fed policy can actually maybe not be directed, but at least be swayed by what's happening in the executive branch. So one of the prior Fed chairman, Arthur Burns, was criticized a lot for being impacted by the presidents that served during his era. Okay, now, this doesn't mean the Fed is independent of congressional oversight. It just means the executive branch. So the Fed can be audited. It can be overseen by Congress. But Congress doesn't do much to do that. So we think that most of the sort of feedback, that mechanism, is happening through sort of backdoor channels and political pressures more than explicit. Now, there are some cases that we see historically where Congress or the executive branch will sort of threaten the Fed with reforms or audits in order to get their way. So sort of, just political gameplay. Okay, so let's talk about the Fed structure now. There's the Board of Governors, which has 7 members. And this is, part of the decision-making branch of the Federal Reserve overall. The New York Fed regional branch is a permanent member of this board, and then you've got a system for rotating other members of the Fed around through that. The Fed also has its reserve banks, and there are 12 regions. These are, I've listed them here, New York City, for example, and then those regions or districts are numbered as, so I've got them in the correct number here. So New York City is region 1, Boston is 2. New York City is sort of the seat of where most of the Fed banking operations happen. So it's sort of the most important, the biggest of the Fed Reserve regions. So they run the open market operations, for example, out of there. Cleveland is a really interesting one. Cleveland used to be even more important than it is now because they ran all the check processing out of Cleveland, right? And then, of course, you've got these ones out west that cover lots and lots of geographic area. Okay, the Fed, in addition to its goals, therefore has functions. It also has 4 functions. The nationwide payment system, that's what I was just talking about there in Cleveland, for literally processing checks. Distributing coin and currency. They take in old coin and currency, destroy it. They distribute new coin and currency. So the Treasury, right, whose job it is to make such things, uses the Fed to distribute coin and currency. There's a lot of interesting videos or articles on the Fed.gov website where they kind of cover how these things work. That's always interesting kind of documentary stuff if you're interested in that kind of thing. And of course, as discussed before, regulating and supervising member banks. Now, not all financial institutions are a part of this, right? So if you've got credit unions, for example, they're not monitored by the Federal Reserve. They're monitored by the Federal Credit Union Association. Okay, and then of course they serve as the banker for the U.S. Treasury and the as I mentioned before, Congress as well. Okay, so one of the most important parts of the Fed structure is the Fed Open Market Committee. You might hear this referred to as the FOMC. It used to be, right? So I'll throw a circle around this. It used to be that the main tool for monetary policy was open market committees. It's not obvious that that's true anymore. We'll discuss that a bunch in detail as we go through this lecture. Okay, but what there still is Federal Open Market Committee, and it still does its work. If you listen to the news, the news reporting on these kind of things is way behind the times in terms of what's actually happening, and so therefore they'll report open market operations and what's happening with the interest rate as being the important thing for how it is that we see inflation fighting, or the opposite when we don't have inflation, fighting a recession or high unemployment numbers, etc. Right? And so this is because it used to be the case that this was main tool for monetary policy. It's certainly not a trivial one now. It's just certainly not the whole picture, and I'm going to give you a much more sophisticated way to look at all of this stuff as we progress through this lecture. So what does the Federal Open Markets Committee do? It oversees open market operations. This is buying and selling government securities, treasury bonds, notes, bills, like I said before. So what does that look like? The Fed then says we want to pull money out of the economy, and I'm going to cover this more in detail in a bit. I want to pull money out of the economy, and so I'm going to sell. So I sell bonds. Bonds go out. Money to buy those comes in, and then the Fed keeps those in its banking system, right? Or they want to put money into the economy, and so they buy. They want to put money into the economy, so they buy up bonds. And so the bonds come into the Fed and the money goes out, and now there's more money in circulation. That's how they do this. Okay, so that's how we use buying and selling government securities to do open market operations. Okay, we have 8 meetings a year for that, and this is important because people closely monitor the reports and decisions that come out of that committee, and this brings us to an idea that we call forward guidance. Forward guidance is an important idea in Fed monetary policy, but obviously Fed policy is monetary policy, right? Fed policy is the U.S.'s monetary policy. So what happens is the nature of inflation is not only tied to the physical realities of the economy, but also people's expectations of them. And so one of the things the Fed can do is they can try to set those expectations by saying what it is they're going to do. So you'll often see, if you're reading a report on a Fed meeting, you'll see something like they did this and they said they were going to do X, right? So an example of this, they raised the interest rates by 75 basis points, and they say next time we expect that we will raise it by another 75 basis points. Okay, so if the interest rate was 0, they raised it up to 0.75, and next time they think they're going to raise it up to 1.5. That second part is what we call forward guidance, and that shapes the way that people behave very, very strongly, right? So it's not just the open market operations to try to target the interest rate. It's also what is happening with it is also what is happening in the future. What they say they're going to do is also very important. Okay, FOMC is composed of the 7 members of the Board of Governors and then 5 of the 12 regional presidents. And as I said before, the New York the New York City president is a permanent member because the New York Fed actually executes the Federal Open Market Committee operations. So it actually runs the operations. Okay, another thing that the Fed does is what we call the lender of last resort. Okay, so the problem with banks, as I said before, is they take in short-term loans, which you and I would think of as deposits, and they make long-term illiquid loans out themselves, right? So this leads banks to have a very peculiar type of risk where they can face bank runs. So bank run is where people panic, try to get their money out of the bank, but banks don't have all your money in their vaults at one time, right? So they'll take in, as we discussed in the reserve requirement ratio, they take in your $100 and then they loan it back out. So if I go to get all $100 that I have out of the bank, it won't always be there. So now on a day-to-day operation, I can go get $5,000 out of my bank, no problem, right? Because there is $5,000 there. There's just not enough if everybody wants to get all their money out. In fact, it's probably a relatively small proportion. It's probably something like 10%. So if all the people who had their money in the bank show up and they all just want to get 11% of their money out, it would probably run the bank down. Now, banks can deal with these sort of like smaller fluctuations like that because they can borrow from other banks, interbank lending, right? The problem becomes if people want a lot or all of their money, and in part because they panic. Okay, so a bank run stems from a situation where they think their bank is going to fail, and so they want to get their money out, and banks then have to sell off those loans that are assets to them, right, at big time discounts in order to get the cash, in order to give the cash to people. Now, the problem with bank runs, right, is they can be real. There can be something about the bank or the financial system that seems risky, and people really should get their money out, or else their money will be gone, right? But they can also be, phantom, right? It can be nothing that caused that. If you saw, there's one of my favorite comic strips ever called Saturday Morning Breakfast Cereal, right? And there's a convention where the supervillains are having a meeting, and they say, we need ideas, right? And one supervillain pitches an idea, and another pitches an idea, all, classic ideas that we'd see in movies. I don't remember exactly what they are. I'll try to put this link up in WT class for you guys so that you can see this whenever you hear this lecture. And, say, we're a nuclear bomb or terrorist attack or whatever. And then an economist stands up and an economist says, okay, this is what we do. We hire people wearing suits to run out of a bank holding a briefcase of money with like money falling out, saying it's all gone, there's no money there. So the joke there, right, is that that's how you can cause a bank run, right? And you can cause banks to fail even though there's nothing wrong with them, right? And so this is this idea that we call bank runs. So one of the things the Fed tries to do is forestall this. So they lend to banks during these crises. This is actually the original reason for central banks, is to fight bank runs, because you and I, we've not really ever seen one of these, but this used to be a substantial problem 100 years ago. And so this is around the time that we saw central banking begin to crop up to try to fend off these bank runs where financial institutions couldn't fail for essentially no reason. And then after 2008, the Fed began to do this lender of last resort to other types of firms. And this was open to non-banks in 2008. So that's a expansion of the Fed's powers. Okay, so what is monetary policy? I'm going to sort of introduce monetary policy so that I can talk about some of what the Fed has done, and then we'll do monetary policy in theory, which is, of course, extremely important in the next lecture. Okay, so what is monetary policy? Monetary policy in practice are the actions taken by the Fed to manage the money supply, interest rates, and pursue macro policy objectives. Okay, the Fed has two objectives: full employment and stable prices, but tacitly, right, that also includes growth. Right? Okay. Now, we've talked about the tools of the Fed. We've talked about open market operations. We've talked about interbank lending, right? The third tool of the Federal Reserve is payment of interest on reserves. So this is new as of 2008, but the Fed would say, if you keep your money with us, we'll give you, we'll pay you interest on it. Because it used to be that banks would hold money with the Fed, and the Fed wouldn't pay any interest on those things. Okay, and this was real foresight by the Federal Reserve, because this added a tool to their toolbox, and they now use this a lot. You might have heard of this. It's called quantitative easing. Okay, so what are open market operations? Open market operations are buying and selling of U.S. government securities. Okay, so the U.S. Treasury borrows money by selling securities. The Fed then buys and sells these to manage money supply. Right, so this is the old school, the main way. Still happens, still important, but hold on to this. Okay, so the reasons that open market operations are the main policy tool of the Fed, up until it wasn't in 2008. Is one, it controls the volume, right? You can do big operations, you can do small operations, you can move the money supply a lot, you can move the money supply a little. It should, in theory, be both very precise and be able to do big changes when you need big changes. It's easily reversible. If I sold too many yesterday, I can just buy some of them back today, and it should, in theory, be quite quick. I mean, it can literally be done in a day. Okay, so open market operations have a lot of benefits in terms of the way that the Fed can operate. Now, the Fed then has a new tool that's called quantitative easing. Okay, so usually the Fed buys and sells short-term debt of the federal government. That's open market operations, right? And the Fed then can target long-term rates, right? So the government long-term bonds that have maturity dates of 10 to 30 years, and they have these long-term securities that they put on their balance sheet. So balance sheet, I just mean balance sheet just exactly like any other bank, right? Like what assets, what liabilities do they have on there, okay? So the quantitative easing, then, one of the things that should happen is the Fed should allow these long-term securities to, quote, roll off. Those debt terms expire. They get paid for being the people who are being the entity that is holding that bond when it matures, right? So if you have a U.S. government bond and the maturity date is today, and you have that, then you can then exchange that for the money, for the cash, right? The liquidity. That's how bonds work. Okay. So one of the ways that the lending that the Fed happens is through what's called the discount window and the discount rate. Okay, this is the interest rate charged by the Fed on commercial banks and other financial institutions when they borrow from regional Fed banks. So banks can do what's called interbank lending, or they can borrow from the Fed. When they do that, they borrow from what's called the discount window. Okay, so it's kind of badly named, right, because it makes you think that it should be like a lower interest rate or whatever. But it's just the rate that the Fed lends to banks. Okay, so when the Fed wants to encourage banks to borrow, it can lower this discount rate and causes banks to then borrow more, which increases money supply, in theory, right? There's a catch there that we'll actually talk about a lot, because this was really important when it came to the 2008 situation. So keep that in your mind. We'll circle back around to that. Okay. Another tool the Fed has was called reserve requirements. This is not so interesting anymore because the Fed actually lowered the reserve requirement to 0 last year. But in theory, right, when banks take deposits in, they have to hold a certain amount of them, what we call against deposits. So if I deposit $100 and the reserve ratio is 10%, then they have to hold $10 and they can lend the other 90 out. Okay. If the reserve requirement ratio is lowered, then banks can lend out more of what then becomes excess reserves, and these are available to be loaned out. Okay. The Fed rarely changes this. So big changes in this are really a very dramatic, large impact. It's definitely a chainsaw, not a scalpel. And so the Fed lowering reserve requirements to zero. Well, this is last year. That's out of date. Lowered this in, when was that? I want to say 2020. In 2020. This is a pretty big move. Okay. Now, the Fed has introduced some new tools. One of these is called a term auction facility. And this is going beyond those traditional tools, the open market operations and the borrowing and the lending. Okay? So the term auction facility allows for borrowing at, I'm sorry, let me set this up first. If a bank borrows at the discount rate, it might actually look bad, right? Because the bank is, instead of borrowing from other banks, it's borrowing from the Fed. Now the people who use that bank look at that and go, okay, what's wrong that they're having to borrow from the Fed? Okay. So the Fed comes along and it announces that it wants to sell off a certain quantity, it wants to target a certain quantity of reserves. Okay. So then they hold an auction. And they hold this auction until the rate is low enough to sell off all the reserves, right? So you just literally have an auction and banks say, okay, I'll take this much at this rate, right? And the Fed, along with this, can then loosen collateral results. Okay, so the term auction facility is a way to try to sort of get around that weakness signal because banks are just getting a good deal then, right? And then the bank can effectively loan out through an auction rather than loan out at their discount window. Okay. Now, remember we talked about that payment on the reserves, so we want to get into some detail there. Okay, so since 2008, the Fed started paying interest on reserves held with the Fed. So bank puts money in the Fed for the Fed to hold it on their behalf. They had to do that. But now the Fed is saying, okay, but we'll pay interest on it. Okay, so now what the Fed can do, this gives them another tool. So they move around that interest that they're paying and hold with the Fed. Well, it used to be zero. Okay, so if the Fed is zero, then what's the point of holding with the Fed? Well, it's very safe, right? You're not going to lose it, but you're not going to gain any interest on it. So banks are sort of doing what they had to do with that. Now, when the Fed has a positive rate on that, encourages banks to hold more with them, and then they can move it around and they can push money in and out of their system, right? It becomes a tool for manipulating the money supply. What's really interesting is, right, this seems like a thing that's like, wait, why would they do this? It's not especially powerful. They have all these other tools. What do they need this for? People began to speculate if the Fed got desperate, it could actually push the payment of interest on reserves below zero. So instead of paying you to hold with them, they could tax you for holding it with them, and that would push that money out into the system very, very quickly. And the reason for that is, as we were discussing before, in theory, right, if the Fed pushes money out into the banks, then they will lend that out. It will go into the money supply. The problem is, what if there's a kink in the system where the Fed pushes money to the banks and then the banks don't lend it out? They just leave it sit in their deposits. Well, that's no different than if it were sitting in Fed deposits, and it won't affect the money supply. Okay, so this is an important part of the mechanism. Okay, so let's talk about systemic risk now. Systemic risk is often tied to what's happening with the reserve requirement ratio at the end of the day. Okay, it used to be that the Fed would assess a penalty if you didn't meet the reserve requirement ratio, which is part of why they dropped this to zeros. They don't want to do this anymore. Okay, so if banks have two options if they don't meet the reserve requirement at the end of the day. One is they can borrow from other banks. This is a source of systemic risk. Now, not just in this situation, but any interbank lending, right? Two, they could hold excess reserves with the Fed, so then they for sure wouldn't ever miss the reserve requirement ratio, right? This brings us to another idea we call the federal funds rate, okay? The federal funds rate is the interest rate financial institutions charge each other. So it's confusing because we call it the Fed funds rate. You think that would be the rate between the Fed and banks, which is not. That's the discount rate. The Fed funds rate is the rate between banks, right? So bank one to bank two, okay? So this is the interest rate they charge each other for overnight loans in order to meet this reserve requirement to stay liquid, etc., so that they don't last. This is a source of systemic risk, okay? So bank one lends to bank two. Bank two goes out of business. Now bank one is hurt very badly by this, right? Because that was an asset to them, so their assets evaporate overnight. This is how banks are different. It would be as if, well, it's hard to construct an example, but going back to our car example, if somehow Ford and GM were lending tools between each other, lending capital for making cars between each other, and if one of them went out of business, all that capital was instantly destroyed. Right, so we could see how Ford would be hurt if GM went out of business. It's a little bit of a wonky example, but hopefully I've conveyed something there to you. Okay, so let's talk about how these kind of problems arise. This is what we call solvency and liquidity. Okay, so a solvency crisis is when a bank becomes insolvent. Insolvency is when banks have liabilities greater than their assets. Okay, so they're upside down in a certain sense. Okay, but a liquidity crisis is a little bit different. This is when banks are illiquid. Banks are illiquid when their short-term liabilities are greater than their short-term assets, but overall assets are still greater than liabilities. Okay, so bank's insolvent when it owes more than it owns. Pretty straightforward, right? But they're illiquid when their short-term liabilities are tying up a lot of their money, and so they just don't have money to move around into the different parts of what it is that a bank wants to do. That's liquidity. Okay, and these, of course, are very bad for financial systems, and this is part of what leads us to a financial crisis. Okay, so as before, right, we want to remember, because we kind of talk about these things sometimes, and it's just like we snap our fingers and we lend money, we snap our fingers and we do open market operations. And open market operations are quick. But we want to remember that monetary policy, like fiscal policy, has some enormous lags. One is the information lag, so what's happening, we have to collect the data. This takes up to 2 quarters, so up to half a year. It's very hard to recognize a pattern in the data, even once we have the data. That can take up to another half of a year. Then we have to decide. Remember, the FOMC meets 8 times a year, so when things happen between those meetings, they don't have as much ability to react to them. And then we have an implementation lag. If we're using open market operations, this is pretty quick, and other types of operations have various different speeds, but we're looking at lags of potentially over a year, but for sure up to half a year. So a lot of times you'll see the Fed, and you're wondering why they're doing what they're doing. Well, it's because they're, in some sense, reacting to what was happening at least 6 months ago, right? So we might look at this as an interesting time to be looking at that, given that the Fed's fighting inflation. We're saying, what are they doing? Well, they're probably reacting to things that were happening 6 months ago. Now, this is not the only problem with monetary policy. There's some other big ones, right? The Fed, I don't even really want to use the word control, right? The Fed has a strong ability to manipulate short-term interest rates, but investment is mostly done in the long term where they don't have much control at all. And so this limits what it is the Fed can do. Okay. Now, the problem is there's lots of things that manipulate aggregate demand, right? And we've seen how inflation happens through aggregate demand moving around and how we target aggregate demand in order to fight inflation. But the problem is estimating and tracking aggregate demand is fraught with a lot of problems. I mean, just any macro variable is going to be like that, right? So let's think about some things that go into aggregate demand that are very hard to estimate what those numbers would be and to track them in any kind of data set, right? Bank lending and borrowing. It's not as if you just have a Excel spreadsheet that adds all of these things up. You have to get reporting from banks, and it's happening every day. It's moving around very quickly day to day to day, and you're adding up data to quarterly data. Okay. Another thing is what we call velocity. We'll have more on this in the next lecture. The speed at which the monetary base gets into and moves around within the system is highly variable. In fact, this may not even really be knowable, right? This is why inflation is one of the reasons that inflation is so damaging, right? Is it's not as if we snap our fingers and money shows up exactly equally in everybody's bank account, right? We put monetary base into the system, and then that goes to particular people's hands, and those people have an advantage, and people that money gets to, air quotes, gets to them later are at a disadvantage relative to inflation, right? So anybody listening to this lecture, you're not one of the people that's going to sort of get the benefit of there being too much money pushed into the system that's eventually going to cause inflation, right? You're going to be downstream of all that, and you're going to pay the consequences. Okay. Of course, business borrowing is even harder to measure than banking borrowing, because banking is happening within the Federal Reserve System a lot of the time, and so we can see measures more directly. Business borrowing is even harder to measure, right? And we do most of that trying to measure it from the opposite side, right? Trying to measure it from the side of the banks and the Fed. Okay, so how fast businesses are going to get borrowed funds and what they're going to eventually do with them is really, really hard to observe. So it makes the Fed's job nigh on to impossible in that regard.